cold open. Imagine this. You hand a street vendor in New York a crisp dollar bill for a bottle of water. He smiles, takes it. Same day, same bottle, different country. You pull out a thick stack of colorful notes, hundreds of them, and the vendor still looks at you, like you're trying to shortchange him. One piece of paper buys comfort in one place. A whole pile of it barely buys survival somewhere else. Why? Not because the ink is different. Not because one country prints prettier money. It's because the hidden machinery behind every currency is running at completely different speeds. And right now, in 2026, that machinery is under more strain than it's been in decades. Stay with me. By the end of this, you won't see money the same way again. The dollar, the euro, the rupee, the yen. They're not just currencies, they're living scores. In a global game, most people don't even realize they're playing, and that game is getting riskier. Why this matters right now. Travel anywhere today, and the numbers hit you immediately. $1 US buys around 150 Japanese yen, about 84 Indian rupees, a little over €1. On a good day, those numbers aren't random, they're the market's verdict on entire economies, updated every second on trading screens from London to Singapore, and they're shifting. In the last few years, we've seen the dollar surge, then weaken, the yen swing wildly. Emerging currencies hit new lows. Now you might think, why should I care? I'm not a trader. But here's the thing. Your savings, your paycheck, your grocery bill, even your ability to buy a phone made in another country, all of it is being quietly judged by this system. A 10% move in your currency can feel like a tax or a bonus you never voted for. This isn't abstract economics. It's why a factory worker in one country can feel richer than a professional in another. It's why wars, elections, even rumors can wipe out lifetimes of effort overnight. So how did we get here? Let's go back. The hidden history. For most of human history, money had a physical anchor, gold, silver. You couldn't just print more without digging it out of the ground. Then everything changed. After World War II, the world created something called the Bretton Woods system. The US dollar became king, and it was tied to gold. Other currencies were tied to the dollar. It felt stable, predictable. Then, in 1971, President Nixon made a shocking move. He closed the gold window. No more conversion. Just like that, money became fiat, backed not by gold, but by government promise and trust. From that moment on, the value of money was no longer about metal in a vault. It was about confidence. Confidence in a country, its policies, its future. That one decision unleashed the modern currency market. A system now trading over $7 trillion every single day. Think about that. Every second, someone, somewhere, is deciding whether your country's promise is worth more or less than someone else's, and that decision shows up in the exchange rate. How the system actually works. At its core, it's simple: supply and demand. Currencies are bought and sold. Like anything else, if people want more of your currency, it rises. If they're dumping it, it falls. But what drives that demand? First, trade. If your country exports more than it imports, foreigners need your currency to buy those goods. So they buy it. Your currency strengthens. Second, interest rates. Higher interest rates attract investors. They move money into your country to earn better returns. That means buying your currency. More demand, higher value. Third, inflation. This is where it gets uncomfortable. If a country prints money too fast, each unit becomes less valuable. Prices rise. Purchasing power falls. And the rest of the world notices. They either demand more of that currency or avoid it altogether. There's even something called the Big Mac Index. A simple idea. A burger should cost the same everywhere after exchange rates, but it doesn't. And that gap reveals how currencies are misaligned. Then there's political stability, rule of law, debt levels. All of it feeds into confidence. If a country looks unstable, its currency gets punished. Fast and finally, speculation, traders betting on the future, sometimes amplifying moves, sometimes causing them. These forces don't cancel out neatly. They stack. A strong economy, low inflation, high interest rates. That creates a powerful cycle upward. A weak system can spiral downward. The uncomfortable truth. Here's the part people don't talk about. Currency value is a popularity contest with real consequences. Central banks can try to control it. They can raise rates, buy their own currency, but they can't fight the market forever. History proves it. Weimar Germany, 1923. Money became so worthless, people burned it for heat. Hungary, after World War II, prices doubled every 15 hours. Zimbabwe, in the 2000s, inflation hit billions of percent. The currency didn't just weaken, it died. Even without extreme cases, the slow decline matters. A currency losing 5% a year quietly transfers wealth from savers to borrowers and governments. It's a hidden tax, and the irony, the strongest currencies are usually from countries that print the least recklessly. Stability wins over time. Hype versus reality. You'll hear big claims. This currency is about to explode. The dollar is finished. Everything will be replaced. But reality is quieter and more dangerous. The dollar still dominates because the U.S. economy is massive. Its markets are deep and people still trust it. But that trust is not guaranteed forever. Emerging currencies offer growth, but also volatility, big gains, and brutal crashes. The euro tried to challenge the dollar, but political complexity created fragility. The yen reflects an aging population and massive debt. Every currency is a bet on a country's future. Bigger picture. Zoom out. Different currency values aren't a flaw. They're what makes global trade work. They guide capital, reward strong policies, punish weak ones, but they also create winners and losers. A strong currency helps consumers, but hurts exporters. A weak one does the opposite. Entire industries rise and fall on these shifts. And today, with rising debt, geopolitical tension, and new digital currencies, the risks are growing. A major loss of confidence in any big currency could trigger massive chain reactions. The same system that makes global trade possible also makes your savings vulnerable. Closing. So why do different currencies have different values? Because countries are different. Their productivity, their decisions, their stability, their future. Money is just the scoreboard. And here's the uncomfortable truth. No currency is safe forever. Not even the dollar. Its value, like all others, depends on confidence. And confidence is fragile. So next time you exchange money or hear about interest rates, remember this. You're not just dealing with numbers. You're part of the largest, most continuous vote on how the world is run. And the real question is, what happens when enough people change their vote? That's the one to watch.